Hello, my name is Clive Corcoran and welcome to my YouTube channel, the Corcoran Codex. And what I want us to look at in this screencast is an explanation and description essentially of how the repo market works. So let us begin by looking at exactly what a repo is. So repo is shorthand really for a longer expression, which is a sale and repurchase agreement. And essentially what we are looking at is a cash transaction whereby a borrower transfers the ownership of a security, which typically would be a government security, to a lender with a promise to repurchase that security at a later date. So it is this promise to repurchase the security that ensures repayment of the loan to the lender and the return of the collateral, let's say the government security, back to the borrower. I'm going in this video to examine the New York repo market, but there are other important repo markets elsewhere in the world, for example in London. Now, the New York market is an essential facility in the provision of liquidity and reserves into the US banking system. I'll have more to say about this in a moment. Trillions of dollars can be exchanged even during a single day in the New York repo market. The rate of interest which applies in that market has become known as SOFR, which is an acronym standing for Secured Overnight Financing Rate. And this rate has become now the cornerstone money market rate that has replaced the old troubled US dollar LIBOR rate. Let me just say a few things about that rate and the LIBOR market generally. The LIBOR market, which was essentially an unsecured interbank market, had existed for several decades, and US dollar LIBOR had become perhaps the most important benchmark rate or interest rate in the world, covering not only derivative contracts like swaps and so on, but also featured in mortgage contracts. Now, the LIBOR rates have essentially disappeared. There's still a residual amount of activity in dollar LIBOR, but it is very minor. The main reason behind that was because the interbank market moved away and became reticent to engage in unsecured lending and borrowing. After the collapse of Lehman Brothers and other banks around the world, the risks associated with unsecured transactions were only too apparent. And also on top of that, there was an egregious LIBOR rigging scandal, which I won't go into in this particular video. Let us now look at the structure of a repo, and essentially there are two scenarios. Let me begin with the one on the screen, which essentially is where we have two, in this case, US commercial banks engaged in this repo, Citigroup and JP Morgan. Let me walk through what is involved in the repo. So at the beginning, let us suppose that Citigroup is keen to obtain some short-term funding or cash essentially, and it goes into the New York repo market. It identifies JP Morgan either directly or indirectly through a third party, and JP Morgan is willing to enter this repo arrangement with Citigroup. What happens next is that Citi, let's say, sells, let's say, $10 billion worth of US treasuries to JP Morgan. And this transaction could be as short as overnight, or perhaps 3 months, 6 months, not usually beyond that. I'm going to assume in my example that it is a 1 month repo. Once the securities have been transferred to JP Morgan transfers the current market value of those securities, which, as I say, let us assume for the moment it's $10 billion. At the same time that this transaction takes place, the sale of the securities, there is an agreement that at some later date, and I'm going to assume 1 month, Citigroup will come back to JPM and buy back these securities. They may not be exactly the same, but they may be similar. There's all kinds of issues around substitutability, which I won't go into in this particular video. So Citigroup now buys back these bonds from JPM, pays back the value that was transferred here, plus a rate of interest. And that rate of interest is known as the repo rate, or the overnight repo rate. Even in our case, it's 1 month, but essentially it's based on an overnight rate, which is then annualized. Now, if all of what I just described takes place, then the repo has completed successfully. What would happen, let's say, though, if sometime during this 1 month period, Citigroup is unable to complete on the second leg of this transaction? It cannot go back to JPM and buy back these bonds. And this is why the repo market is so well suited to providing liquidity, is that JP Morgan would be fully empowered to sell immediately the securities that had been sold by Citi at the beginning of this deal. And under bankruptcy law, there is no restriction on JP Morgan's ability to be able to liquidate those securities immediately. It would not need to sort of stand in line with various other creditors who are trying to receive some compensation from Citigroup. Now let's turn to a second scenario where we still have Citigroup over here, but now on the right-hand side, the counterparty now is not a commercial bank, it is actually the Federal Reserve. So the same logic applies, and Citigroup has sold the securities. The Fed now is paying for those securities. And let us now look at the mechanism which would be in effect, and which is very helpful in terms of understanding the critical role that the central bank, the Federal Reserve in this case, fulfills, say, in the New York repo market. When the Fed buys these securities from Citigroup, what it does is it credits the reserve balance that Citigroup must hold at the Federal Reserve, within the Federal Reserve system. All commercial banks in the US are required, it's mandatory for them to hold deposits essentially with the Federal Reserve. And these reserves are mandatory, and the size of them hinges on various factors, including the size of the deposits of each of the banks that are required to hold them. So when the Fed has now acquired these government bonds, let's say, it then credits Citi, in this case, for the amount of the commercial value or the market value that was transferred. So no money is actually moving around. It is simply a book entry on the computerized ledger system of the Federal Reserve itself. At the end of the period, which in this case is 1 month, Citigroup goes back to the Fed, buys back the bonds, and the way that that is handled is that the reserve balance now from Citigroup is debited by whatever the amount here was, approximately 10 billion. And of course, there is also a rate of interest applied where Citi pays interest to the Federal Reserve branch in New York. So a moment ago, I mentioned that this rate of interest, the repo rate, is also known as SOFR, or the Secured Overnight Financing Rate. So let's have a quick look at the recent history of this rate, and going back here to sometime in early 2020, around the time of the onset of the COVID pandemic. And as you can see here, as was the case, the SOFR rate was virtually zero, in line with the Fed's policy rate, the federal funds rate. As we started moving into 2022, when inflation became a serious problem, the Fed, alongside other central banks around the world, kept hiking the policy rate, the Fed funds rate. And in more recent times, this has now come down, as of when this is being recorded at the end of March of 25, to 425 to 450 basis points. Now, what I want to talk about now is going beyond the essential mechanism of the repo market that I've described, and I want to go on and explain the really quite critical role that the Fed has within the New York repo market. And I'll begin by looking at what I might call the routine role in the repo markets. So the New York Fed is authorized by the FOMC to conduct repo and reverse repo operations for the system open market account to the extent necessary to carry out the most recent FOMC directive. So let me unpack this a little bit. Now, the system open market account is essentially managed by a trading desk within the New York branch of the Fed, and it keeps track of the activities of the Federal Reserve when it is the counterparty in the repo transactions that I just described. And to just mention the recent FOMC directive, this would be with regard to the policy rate that was decided and is in effect at the current time and decided by the Federal Open Market Committee. Now, that essentially is the policy rate, and it is known as the Fed funds rate. And the way that this is expressed by the Federal Reserve, unlike, say, the way that it's quoted by the Bank of England or the ECB, is that the policy rate is expressed as a range between an upper and a lower bound. And when this is being recorded, that range is currently 425 to 450 basis points, which makes this rather unusual because, as I say, if you consider by comparison the way that the Bank of England operates, they simply state a rate. And the fact that there is this range is a useful background to thinking about how the Fed actually operates within the New York repo market, because, as can be seen down here, the range, as I said, 425 to 450, what the Federal Reserve can do, and used to do a lot more currently, because now there are other facilities that are available, but this certainly was very much the practice for extended period, was that the Federal Reserve could go into the repo market with a view to essentially micromanaging the prevailing repo rate in the New York money market. So let's us say, for example, where as you can see here, this is on the 28th of March 25, the final rate was 4.34%, 434 basis points, which essentially is pretty close to the middle of that range of 425 to 450. Let us suppose now that the Federal Reserve is monitoring the desk in New York, this one I mentioned, is monitoring the prevailing rate in the repo market at any point in time. And it sees that the rate that is prevailing currently is a little higher than it would like to see it, and perhaps above the middle point of the range that I mentioned. What the Fed can then do is add liquidity to the repo market via doing repos and adding liquidity into the banks via the reserve balances, which would then tend to diminish the rate. And if, on the other hand, it sees the rate is perhaps not where it would like to see, is lower than it would like it to see it, it could do the opposite, which is to conduct a reverse repo operation. In other words, the Fed is then selling government securities, let's say, to the banks. The banks are paying for them, which leads to a diminution in their reserve balances, and that will tend then to have the effect of increasing the prevailing repo rate in the New York market. Now I want to turn to less of a routine role and more of an emergency role, which the Fed has from time to time engaged in with regard to the activities in the repo market. Now this, as you can see here, is dated in March of 2020. This is exactly around the time when the world was learning of the severity of the COVID pandemic. There was obviously a dash for cash as businesses were being asked to go into lockdown. Revenues fell off a cliff. Cash was very much in demand. And here you can see an announcement by the Fed saying that they were going to offer $500 billion in a 3-month repo, The next day, another 500 in a 3-month repo, and yet another 500 billion in a 1-month repo. And they carried on by saying that the desk will continue to offer at least 175 billion in daily overnight repo operations. And over here, this comes from a Fed document. You can see the extent to which the Fed's purchases in the repo market did lead to a massive injection of liquidity in line with what is discussed over here. The final slide has to do with the issue I mentioned earlier. Now, the collateral, the securities which would be involved in the repo could, let's say, primarily be US Treasuries, but they could be some other types of security depending on market conditions and so on. And let's just talk about the value of that collateral. So the initial cash would be paid, let's say, by either the JP Morgan in my example, or even the Fed, based on the market value of the collateral, and then would be usually subject to a haircut, let's say 2%. So then Citigroup, you go back to the original example I mentioned, let's say it passed, I don't know, $10 billion worth of securities onto the lender, JP Morgan. That 10 billion would then be discounted by 2%, so that the borrower, Citigroup, would actually only get 98% of the market value. And this haircut is to protect the lender in case of a decline in the market value of the collateral. Another possibility would be over-collateralization. And the value of the collateral is its current market value, including accrued interest and coupon amounts. The seller in our example, Citigroup, although it has temporarily transferred ownership of the government securities to JP Morgan, would actually still receive coupons that might be paid out during, let's say, the life of the repo. And that concludes my discussion of the repo market. I hope you have found that useful and interesting. And could I please ask you to subscribe to my YouTube channel, where we analyze critical ideas and episodes in the world of finance. Thank you.